guys, Infosys numbers are flashing for you on your screen, and the first take is it's a revenue beat. The company has reported a constant currency revenue growth of 2.6% quarter-on-quarter versus estimates of 1.5%. Anyway, Infosys was expected to be the only IT company in the large cap space to report growth this time, but the growth is much better than expectations. So 2.6% is the top line revenue growth, a beat. Margins have come in at 20.8% versus 21%, so a drop of 20 basis points sequentially, but that comes in line with expectations. Now to the FY26 guidance. The revenue guidance stands at 1 to 3% versus 0 to 3%. That is in line with market estimates because the street was saying that anyway the company, had done two acquisitions, the MRE acquisition and the Missing Links acquisition. These two were expected to contribute to the FY26 outlook, and therefore the lower end of the guidance was likely to be raised. So the guidance doesn't come as a surprise. It's an upgrade at the lower end. It stands at 1 to 3%, but it's in line with expectations and expected courtesy on account of the two acquisitions, small tuck-in acquisitions, which they did in the prior quarter, so that was going to benefit. Margin guidance has remained unchanged at 20 to 22%, again in line with street expectations. The deal wins have come in quite strong at $3.8 billion. Now, this compares with about a $2.6 billion in the prior quarter, and the last four-quarter average was also about $2.5 billion. So deal wins has seen quite a bit of a tick up, and the company says that the large deal win TCV is 3.8 and 55% of it is net new. So all in all, it's a good quarter for Infosys. There are no big misses right now. Revenues beat, margins in line. FY26 guidance on expected lines has been narrowed on the revenue end to 1 to 3%. Margin guidance has been upheld. Just trying to read the statement that Salil Parekh has made, and if you can glean anything from his statement on the environment. Okay, so our performance in Q1 demonstrates the strength of our enterprise AI capabilities, the success in client consolidation decisions, and the dedication of all our employees. Our large deal wins of $3.8 billion reflect our competitive positioning and deep client relationships. So that is, the statement that's coming in from Salil Parekh. But the growth this time has been industry leading at 2.6%, much ahead of expectation. The company has executed very well, and they've largely managed to protect their margins, and deal wins are also very promising, $3.8 billion. So it's a good start, to the year for Infosys, and it's a good way to end the IT earnings season, at least for the large caps. Prakash is now joining in. Prakash, through the day, Infosys was going into its earnings with strength. It's only towards the end that you saw the stock falter. There was some nervousness which kicked in and the stock fell in the dying minutes of trade. Your thoughts on Infosys Q1 numbers?
I think very, very heartening to see these numbers. As you rightly said, the word growth could only go with Infosys, not with other three major IT players. And what it also does is it probably starts, bringing up the possibility of a very disproportionate allocation to Infosys within fund portfolios. Institutions have been really, I'm sure they're worried about the lack of growth and the negative growth and all that in some of the other names. But here you have something which continues to deliver. And remember, the new orders, 58% is from, the order book is from newer orders, which is exactly diametrically opposite of what others have been reporting. So I think on all counts, it's done well, and it's promising to do well. As of course, we'll see the fine print within the commentary, hear them out. But my sense is that this is a stock that will see serious allocation come its way as compared to the others.
Okay, I remember last quarter, Infi was a miss. The street was disappointed. So it's good to see the company make a comeback in Q1. Rahul Jain from Dolat Capital is now with us. Rahul, share your initial thoughts on Infi's numbers. How do they compare versus your expectations?
So we have to see it from two perspectives. Vis-a-vis what we were anticipating. So it's definitely a beat on that front because we were anticipating 1.5%. And that too driven by the inorganic contribution. This is much higher than that. And secondly, also from a relative point of view, the way we have seen other companies report in this quarter, this look significantly premium to that. However, one thing which is difficult to comprehend at this point is that the guidance they have scaled only on the bottom end at 1 to 3%. So that 3% number which has not gone on the top end is something to watch out for, because this would mean the implied growth for rest of the year may not be very exciting. So if they say that the inorganic contribution was higher and the guidance is X of that number, then it still look better. So that is one thing we need to see in the numbers.
Generally, when they change the guidance, it's always including the acquisitions, because it's very hard to separate out the impact of the acquisitions, especially once the integration is done and you've got the whole year. But Rahul, what they had said in the prior quarter when they gave that guidance of 0 to 3%, they said lower end, that 0% assumes a deterioration in the macro environment. The upper end, 3%, assumes steady to slight improvement in the macro. Now, between Q4 and Q1, we haven't seen the macro deteriorate. It's not improved, but it hasn't gotten worse. So maybe that also, along with the acquisitions, has given the management confidence about upgrading the lower end. And on the, when it comes to the upper end, though Q1 was a beat, they've still not gone ahead and raised the upper end. Perhaps it's just, one quarter and the dust is still not settled on the entire, on macros. It's not that clients have come out and started spending their unallocated tech budgets. So maybe they'll wait by to see one more quarter before tweaking the upper end of the guidance. But this is the fifth large IT company to report their numbers. Now, based on the first four numbers that we had, there was no confidence in IT or buying into the IT stocks, just purely based on the numbers that we had, negative revenue growth, companies are not giving wage hikes, margins came under pressure for a company like HCL Tech. In fact, they lowered the margin guidance too. Do you think Infy's numbers, because they're, it's a good set of numbers, right? No negative surprises. Investors will once again have confidence back in the sector? Or do you think it's going to be very specific to Infy?
Yeah, we have seen this in the previous quarter also, that only Infy HCL Tech at that point of time was confident on growth versus the rest of the pack. And this time HCL remained confident on the growth, but yes, margin they have disappointed. Now, with this, we won't see this helping anybody else, because we are seeing that divergence in performance right from the previous commentary as well. So this is right now a positive for Infosys alone, but it definitely adds up to confidence if the commentary overall improves for them, because that will be reflected in others' commentary in the gradual period. But that we would learn once we see what they have to comment across vertical and geographies.
But it's definitely going to provide investors a sigh of relief, because if you remember, in Q4, Infosys revenues had dropped 3.5% quarter on quarter. So it was a low base sequentially, but the performance and execution has been on the stronger side. Mayuresh, you want to chime in with your view on Infosys? How does it stack up versus the rest? What's the positioning in your portfolio?
So as far as IT stocks are concerned, we are positioned in a couple of mid-cap names, Persistent and Coforge, in our portfolios. But as far as Infosys performance is concerned for this quarter, relatively better compared to the rest of the pack. And therefore, I think the revenue beat is something which, as you rightly pointed out, is a huge sigh of relief. The expectations in terms of margins remaining in the 20 to 22% band is a sigh of relief as well. And though I think the constant currency guidance growth of 1 to 3% has been up on the lower end, I think there is some expectations that at least for this year, assuming tariffs, discretionary spending, etc., that they'll still be able to manage some reasonable growth. So yeah, reasonable numbers compared to the rest of the pack. The stock should open positively too.
Expect the stock to open positively. Shrikant, what's the technical positioning in Infosys?
See, for Infosys, the stock has managed very well to sustain above the levels of 1550, 1530, despite there was weakness in the entire IT pack. So I'm of the view that the stock is again heading for the levels of 1640, 1650, where it has next leg of resistance. But broadly, I am of the view that this one is the relatively outperforming stock, and this can this may even also move towards the levels of 1700 or 1750. So broadly, I'm of the view that we should look for creating a long position, even if it is like opening higher to the levels of 1630 or 1650.
The company's hiring headcount addition has been muted. It's added about 210 employees on a quarter-on-quarter basis, and attrition has ticked up by 30 basis points to 14.4 versus 14.1% in the prior quarter. But attrition has steadily inched up for the company over the last 5 quarters now, from 12.6% in Q4 of FY24. It's now at 14.4%. Still perhaps in the comfortable range, but you have seen attrition pick up a bit. Rahul, the press conference is at 4:15. What would be the key watch points? What would be the questions if you had a chance to ask the management?
I mean, there are a couple of smaller print. One, of course, as you said, the commentary, the client sentiment, that is an obvious one to ask for. Within operating metrics, we would like to see, as you highlighted, the headcount has remained same. Utilization has gone up by 120 bips. So their thought process on further hiring and utilization is something which would add up to the confidence on how they are seeing the environment. So that would be another thing. And TCV win has been strong, but what we have seen in the past is a timely ramp up and customer confidence on that. So some of the feedback and those elements would be crucial. And of course, the inorganic element within the current numbers.
Got that. Mayuresh, deal wins are very strong, and they have been for a lot of the IT companies. Yesterday, when Zensar did their call, they said, in a way, I may be paraphrasing, that they're avoiding vendor consolidation deals because it's a race to the bottom. They're so competitively fought that even Wipro said that, right? These deals, cost consolidation, the cost optimization, vendor consolidation are competitively fought. There is pressure, and it's then up to the IT companies to try and optimize margins over the life of the projects and try and protect the margins. But, as Zensar in a way said, it's a race to the bottom. So although you are seeing these large deal wins by the IT companies, do you think it's going to start hurting at the margin level? Because plus this, AI in a way is deflationary.
It is, Rima. And therefore, I think companies which will have a niche offering specifically in this space, I think they are going to benefit quite significantly. Because at the end of the day, if there is pricing-led pressures that probably come through at some point of time in the areas that a lot of these companies operate out of, and there are a lot of interlinked areas for a lot of these IT companies at play as we speak, that might create some element of hassles as far as the overall margin performance is concerned. And therefore, in my opinion, again, I think niche companies which have niche offerings are operating out of niche areas. I think they might actually be winners over the next few quarters.
Mayuresh, Srikanth, Rahul, thank you very much for joining us. It's the first take coming in from Infosys. Infosys clocks in a good Q1. Revenues come in higher than expectations at 2.6%, margins in line at 20.8%, profits too ahead of consensus expectations. The company goes ahead and raises the lower end of its revenue guidance for the full year. For FY26, they're now penciling in a growth of 1 to 3%, with the margin guidance unchanged at 20 to 22%. Strong deal wins perhaps gives the company confidence. Deal wins have come in at $3.8 billion. And also important to note that Infy is the only large cap IT company which is clocked in growth in the current quarter. This has been a tough quarter with the tariff uncertainty looming large on all macro decision. Clients have held back on their decision making. Many projects have been paused across the board in the industry. So it's been a tough quarter. Infosys has executed well and clocked in a growth of 2.6%. Well, that brings us to a close in this edition of the show. Thank you very much for watching. We'll come back with more news and updates.